So what does this mean for, what do we see going forward? If I could show you just one chart, and I could stop the presentation right here, though I would point out that I've got another 20 slides to go, so I'm not going to do that, it would be this one. Because what it's showing you is the decline in mortgages and consumer credit in the US. This is the deleveraging that needs to take place in the US. Consumers in the US, they spent too much money over the last number of years. They've got to pull back on their spending. They've got to start saving more. They've got to start deleveraging. The problem with this is deflationary. Now, what's countering that and what's delaying that deleveraging is this last bar, the federal government. The federal government has been compensating for the decline in spending and borrowing in the private sector by spending more money of their own. And why are they doing that? Because they are very scared of deflation. Given their experience from the Great Depression, they would much rather risk inflation than deflation. If we get into a deflationary spiral, they are worried that it's going to be very hard to get us out of it. So they are spending money in order to compensate that. But overall, when you look at the implications of this deleveraging, it's one of the reasons why we think GDP growth is going to be slow for a period of time, and also why the unemployment market is going to be slow. Now, how successful has the US government been at avoiding deflation? Not too bad. If you look at this red line, the 2% is the upper threshold of what the US or the US Federal Reserve would accept for inflation. And January inflation, the headline inflation number, about 1.6%. So that's well below that 2% threshold. If you look at the core CPI, and core is X food and energy, it's even lower. So based on this chart, there's no problems with inflation. In fact, we really, based on this, would actually be more worried about deflation. And the US is still worried about deflation. One thing we point out about this, though, is we are starting to see some increases in food and energy, as everyone knows, and we would expect that that is going to start to filter through to the headline and core CPI rate over the next year. But we do think it's going to be more of a one-time hit. Given the slack in the labor market, it's unlikely that we'll see a lot of wage growth. And unless you get wage growth, we don't think you're going to get those inflationary expectations build up into the market. So the hope is that, yes, we will see some inflation, but it's not going to be sustained. And there still is a risk, given that deleveraging, of continued worries on deflation. Now, one of the things we are worried about is what we are seeing in interest rates. And you can see from this chart, it's taking the 30-year bond rate from 1982 to present. And you can see that red trend line is a consistent move down. The concern is, at the far end there, we're seeing it pop up above that trend line. And it's a question of, is that, I'm going to go back there, is that something to be worried about? What is moving that up? And we, part of that move is some concern of inflation, but a lot of it is that recovery we've seen in GDP and the economy. And so that's good. So we're not too worried about that, though we are worried in the longer term that that interest rate is going to start to move up. And one of the biggest reasons for that is this next graph, which is the US deficit. You see the green line is receipts, tax revenue, the red line is spending. President Obama just recently announced his 2011 budget. He's estimating the US deficit this year will be $1.65 trillion. That is a phenomenally high amount. As a percentage of GDP, 10.9%, that is a post-World War II high. Now, luckily, he's saying also in this budget that by 2017, they're going to get down to 3% of GDP. And in all of that, actually, is interest. He's going to structurally balance the budget within 5 years. Now, lucky for him, he's planning to do that all after the next election, but still, we think that number is wildly optimistic. If you look at the trend line of tax revenue as a percentage of GDP over the last 20 years, it's traditionally been about 18%. And yet, Obama is planning to raise money at 20% of GDP. So he's planning that tax revenue is going to be above trend. What are the assumptions he's using? Well, interest rates short rates of 3.6, longer rates of 4.7. They seem a little low to me, but I'm not going to argue with that. It's sort of within reason. It all depends on what happens with inflation and some of the other things we're going to talk about. But what I think is wildly optimistic is 6.4% unemployment rate, and a GDP growth of 5.1%. There's no way he's going to hit that target. The deficit and the debt, accumulated debt, is going to be higher than they're estimating. But it gets worse because this is in the short term. If you look longer term, the picture gets even worse. The yellow line is where we are right now. The blue line, or you can see what this is, the layer of spending as a percentage of GDP on defense. So you see defense, that blue line going in the out years is fairly flat, which is good. Means as a percentage of GDP, we're not going to be spending a lot more on defense, we hope. Discretionary spending, which is basically everything else, you can see it actually, I think it's actually moving down a bit because they're going to tighten their belts and spend less. Social Security, and then finally in Medicare and Medicaid, you can see that total blue line is on an upward slope. That means you're accumulating more debt. The black line is revenue. That's your tax revenue. Anytime you got the blue line above the black line, it's a deficit. And you can see right now, right where I've got the arrow, that's where he's balancing the budget, apparently. So that'd be good. But the blue line keeps going up. That deficit over time goes up at an increasing amount. That's telling you that the debt is unsustainable. But it's even worse than that, because I've excluded one very important thing on this graph. And what is that? Oh, sorry, I forgot. So if you put in that trend line, the 18% trend line, it is even worse. But there's something else I've neglected to put on this graph. What is that? It's interest rates. There was no interest rates on that. If you look at the yellow, the dark yellow is interest on existing debt. The lighter yellow is on future debt. That line goes even steeper. This is unsustainable. It's something that's a big concern. They need to cut entitlement spending. But it's a tough thing to do. As you can see from this cartoon, John Boehner is the new Speaker of the House, Republican Speaker of the House. The Republicans took control of the House of Representatives under a mandate to cut government spending. But as you can see from this, it truly is a tough nut to crack. And the reason is because most Americans, they don't want their entitlements cut. This is a vote loser. And especially as you're coming up in 2012 to a very important election, nobody wants to be the one to stand up and be the first one to say, yeah, you know what, we got to cut Medicare. We got to cut your Social Security, not if you want to get reelected. So what are they going to do? Well, they're going to kick the problem down the road like they've done always and worry about it, after 2017, after the election, or never. The problem with that is how long can they do that? Because eventually, people are going to stop paying or wanting to hold that debt. They're going to want higher and higher interest rates for that vast accumulation of debt that's being gathered. But the U.S. has a solution for that. They have a plan. They're very smart. If you look at who holds the foreign holders of government debt right now, you can see about $200 billion is held by the oil exporting nations. They have plenty of money, unless they have more revolutions, to buy more government debt. We're not sure about Britain. We think they have more problems than the U.S., but we don't see how they can buy more. Japan, they own a lot of U.S. debt. John Malden has described Japan as a bug in search of a windshield. The demographics in Japan are awful. We don't see how they're going to add more debt. China, if you believe that what we need in the world right now is a global rebalancing, meaning North America and the developed worlds need to spend less, save more, and China needs to actually develop a middle class and spend more, then you would argue that China is not going to be a big holder of U.S. treasuries in the future either, especially not a new buyer. So where do you go? Well, look who's the biggest holder of U.S. treasuries, bigger than all of these foreign countries. Well, it's the U.S. Federal Reserve. It's the U.S. government themselves. I mean, what they've done under two different programs, two quantitative easing programs, they bought $1.5 trillion in mortgages in order to keep mortgages rate low. And then in November, they announced $600 million of Treasury bond purchases. They're going to buy $75 billion, Treasuries a month for 8 months. Now, and you might not be able to see it, but if you look at what the Treasury is issuing and what the Federal Reserve is buying, it's almost a perfect match. They're buying what the Treasury is issuing. It seems perfect. To us, this seems like a scheme that old Bernie Madoff would be very proud of. In fact, Bill Gross, the biggest bond manager in the world, has called this a Ponzi scheme. He actually called it a Sammy scheme, referring to Uncle Sam. Basically, what the U.S. is saying is, don't worry about our debts. We'll buy our own debt, and we'll keep interest rates artificially low. The problem is that eventually this is going to lead to inflation and a lower U.S. dollar. So we have a lot of concerns on how this is going to play out. Now, turning to Canada, because I've talked a lot about the U.S., and I know a lot of people are probably sitting thinking, why is he talking about the U.S. so much? We live in Canada. We don't care. Well, this is why we do care. Because if you look at a graph of U.S. GDP versus Canadian GDP, and I don't even know which is which. I mean, they look the same. There's a high correlation between Canadian GDP and U.S. GDP. The biggest reason for that is that if you look at Canada's trade as a percentage of GDP, it's 60%. We are the second largest, after Germany, we're the second largest trading nation in the world. And most of that trade is with the U.S. Yes, we have been increasing trade with other countries like China, but still a vast majority of it goes to the U.S. And if the U.S. is going to slow down, it's hard to see how Canada can have a higher growth rate. So, our view on what's happening in the U.S., that slow deleveraging growth, we think that that's going to impact Canada as well. Now, one of the things where we haven't slowed down and we haven't been the same in the U.S. is the employment market. You can see from this graph, Canada, we lost less jobs and we've gained them back quicker than the U.S. The unemployment rate in January in Canada at 7.8% versus 9% in the U.S., so a much lower unemployment rate. What's better is, we lost 400,000 jobs in the first 12 months in the recession. We gained them all back in the next 12 months. That is certainly a claim the U.S. is nowhere near making. One of the areas, though, that's starting to concern us is the housing market. And again, this is a positive for our economy. You can see the housing market in the U.S., we've already talked about it. It's rolled over. It looks like it's double dipping. The Canadian housing market continues to move higher. This is good. It adds strength to the economy. One negative implication is that when people, when their house is going up in value, they feel wealthier. And when they feel wealthier, what do? They spend more money. And one area that is a concern is the amount of debt, household debt, as a percentage of disposable income that Canada is accumulating. If you look at Australia, Britain, and the U.S., they've already started to deleverage. You're starting to see that ratio move lower. In Canada, it's continuing to move higher. And John's got some slides and some discussion on this as well. But, we think this is a real risk. Canadians have to start deleveraging. And if they don't, they're going to be at risk if interest rates start to fall. So we think that this is something, when we look at Canada, a lot of good things happening, but there's obviously some negatives as well. Now, this is my favorite graph, because as bad as Canada is, again, reiterating what we're seeing in the U.S., U.S. needs to tackle that entitlement spending issue. You're going to hear a lot of rhetoric in the news about cutting spending, even cutting defense spending. That is a smokescreen. It has to be the entitlement spending, the discretionary spending that we showed on the graph before. This is small potatoes. If they don't tackle entitlement spending, and soon it's going to be an ongoing problem. And I don't think I could say it any better than Senator Mark Warner. He is a Democratic senator from Virginia who said, if we don't put this off, we are approaching Armageddon. And he's talking about that entitlement spending. And these are very harsh words. And when you're talking about a country like the United States, Armageddon, really? I mean, but it wouldn't be the first time a society as great as the United States went from that to that. So in summary, we think the economy is going to continue to recover, but the deleveraging is going to mean it's going to be slow and volatile. You're going to see a lot more of that game on, game off type of markets. We think employment and housing are going to remain weak, and we think you have to watch inflation. We don't think it's an issue, but it's certainly something, as oil keeps going up because of what's going on in the Middle East and food prices keep moving up, with weather patterns being unpredictable, it's something we absolutely have to be aware of. We think interest rates are going to remain low in the short term, but we think there's a real risk they could move higher in the longer term. I think Canada is better off than most countries. We come out of the recession very well, but we got to make sure we don't fall in the same trap the U.S. had in accumulating debt, only to have to, have the markets tell us that we've got too much and we've got to cut back. And again, and John's going to talk about this a bit more, but in order to, to fight or to position yourself for this kind of environment, cash flow and a diversified portfolio are definitely the key.